Not only is our dividend portfolio beating the market, but 5 of the stocks have nearly tripled the return on the S&P 500. In this video, I'll reveal the power behind these dividend-paying companies, why shares are surging, and how you can use it to pick dividend stocks for your portfolio. We're talking the best companies that pay dividends today on Let's Talk Money.
Beat debt.
Make money.
Make your money work for you.
Creating the financial future you deserve.
Let's Talk Money.
Joseph Hogue with the Let's Talk Money channel here on YouTube. I want to send a special shout out to everyone in the community. Thank you for taking a part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. Now, our 2019 Dividend Stock Challenge just passed that 6-month mark, and I'm still amazed at how well this portfolio is doing. Look at some of these stocks in the portfolio. Hanesbrands, 80% return in 6 months. General Mills, 44%. Bank OZK, 41% return. Now, 5 of these 7 dividend stocks in the portfolio are beating the stock market, which is even more amazing when you consider the S&P 500 just had its best 6 months since 1938. Now, I'm going to update you on the entire portfolio of dividend stocks. Then we'll dig a little bit deeper into those 5 stocks averaging a 46% return. I'm going to dissect why these dividend-paying companies are doing so well and how you can use that to pick better stocks for your portfolio. Now, I'm putting this video into our 2019 Stock Market Challenge playlist, so if you haven't seen those other updates yet, check those out. Along with some of the biggest investing channels here on YouTube, I created a $1,000 portfolio in January, and I'm going to be tracking it all year long. To track my portfolio of dividend stocks, I'm investing $1,000 on M1 Finance, a no-fee platform that lets you pick your stocks and automatically invest any new deposits across the entire group. Now, I'll leave a link to the playlist of videos below in the description. Click through to see how we set up that portfolio and how I picked these dividend stocks. Before we get started, I do want to give a quick shout out to 2 more channels in the Grow Your Dough Challenge. Sarah, the budget girl, recently updated her progress using a robo-advisor for her $1,000. I love this idea because Sarah is all about frugality and budgeting, but maybe doesn't want to spend a lot of time on investing, so that robo-advisor idea is a perfect solution for her. Rebecca on the Squintillions channel is investing across 6 platforms, including some really popular ones here like Acorns and Robinhood. So a great way to look at how she's using these different platforms. Now, I'll leave a link in the video description below to their latest videos in the challenge, so make sure you check those out. So here's our dividend portfolio through June with a 26% return so far this year. We had that rough patch in May, though the portfolio lost much less than the market because of that repositioning we did late April into those REITs, utilities, and bonds. Now, what's been really amazing, though, is that even though we have some of those safety plays that protected our money, the portfolio has rebounded even more than the market since those May lows. And a lot of this has to do with those 5 dividend-paying stocks beating the market that we'll talk about later. So here's our portfolio again, and we'll cover those first 5 in detail, so I don't want to touch them here in the update, but man, it's hard not to love Hanesbrands here with an 80% return. Scrolling down past the 5 that we'll talk about, we see first here the Vanguard Real Estate Fund, ticker VNQ, and this one was one of those real saviors during that May sell-off. Here we have a diversified real estate fund that pays a 4% dividend yield and has jumped more than 20% in 6 months. A lot of the outperformance here is the fact that interest rates have come down hard over the last year, so we have a lot of those rate-sensitive investments like real estate, utilities, and bonds doing really well. Now, this actually should be a huge warning sign for investors, but nobody is paying attention. Since May, it's been those rate-sensitive safety sectors that have been leading the market higher, not the economic growth names like tech and financials that you would expect. This is a warning sign because if you look at the reason these sectors are outperforming, falling interest rates, it's because the economy isn't looking so hot. Now, we've got lower growth, corporate profits that will likely meet the definition of an earnings recession in the 3rd quarter, and yet the stock market is notching record highs every day. There is a disconnect between investor sentiment and reality, and that's where things usually turn really bad really quick. But let's get back to our portfolio because I want to get to highlighting those first 5 stocks to help you make better investment decisions. We've got the Ishares China Fund, this ticker FXI that just started rebounding, but I think still has some great long-term value for investors. This Alerian Mlp Fund of energy assets, now ticker AMLP, this took a huge hit on those lower oil prices, but remember this fund pays an 8% dividend. So you're collecting that dividend and oil prices have some solid support, with OPEC just announcing that they're going to extend those production cuts for another 9 months. The iShares MSCI European Financials Fund, ticker EUFN, has lagged for a lot of the year, but adds some great international diversification, especially when those rates are controlling so much of the direction in the market. So this fund is going to move with those European rates and financials rather than a lot of our other investments tied to US rates. Finally, here is the Blv Bond Fund and the XLU Utilities Fund that we put on just before May. Now, these didn't do much for us in the last month, but a 6% return in just 2 months on a bond fund is huge, and I expect both of these to do well for the rest of the year as both protection from weakness in the stock market and upside potential as the Fed cuts rates. Now, I know it was a quick update this month because I want to get to those 5 stocks that we're going to talk about, but click through to watch those other videos in our Dividend Stock Challenge to see exactly how we put this portfolio together. Now, I've actually been thinking a lot about 2020 lately. Our 2019 dividend portfolio is going to be hard to beat, so I'm looking for ideas or investing themes for our 2020 portfolio challenge. So what do you think we should cover? I'll be investing another $1,000 into a portfolio, but should I stick with dividends, maybe try growth investing or value stocks? I spent so much time working venture capital, part of me wants to do like an acquisitions target portfolio, but let me know in the comments below. What investment ideas should I use for our 2020 stock market challenge? So we see the overall portfolio here beating the S&P 500 with an 18% return so far in 2019. We also see the Vanguard Dividend Appreciation Fund, ticker VIG, which I'm using as a benchmark. Now the portfolio is just running away, beating the market by 7.5% in the first 6 months of the year. But I wanted to dig a little deeper this month to see why some of those standouts are really zooming past the rest of the market. Just these top 5 stocks are sporting an average 46% return in the last 6 months. Now first you have Hanesbrands, ticker HBI, with an 80% return, with most of that in the first quarter. Now one of the themes you're going to see if you look back into those first few videos in that dividend series is deep value, and this has a lot to do with these 5 stocks outperforming. All 5 of these stocks, and especially Hanesbrands, were trading at deep discounts on price to sales and cash flow basis. The problem though when you're looking at these deep value stocks is always going to be timing. You see Hanesbrands had been falling since 2015 before it started rebounding this year, and it's still down 50% over that 4-year period. What made this year different though is that it had a catalyst, something that could turn investor sentiment and get the shares rising again. Now I found those catalysts in the activewear growth rates and the direct sales numbers while looking over the company's financials back in December. Activewear is growing at twice the rate of the broader apparel category, and the company has seen stronger profitability as it shifts more sales online. Now I knew it wouldn't be long before the rest of the market saw this and picked up the shares back off those bargain basement prices. The moral here is that if you're going to be looking for value, it can't just be about low price to earnings ratio. There has to be a catalyst to turn that investor sentiment around. Now the gains on General Mills, ticker GIS, have been smoother with that slow and steady all the way to May and almost a 44% return this year. In February, I pointed out the company's acquisition of pet food brand Blue Buffalo as a big boost to that top-line sales number. U.S. pet food sales have been growing by 5% annually over the past decade, way above other food sales, so this acquisition was a game changer for General Mills. Not only was the company able to tack on that big sales growth, something that's unheard of these days in that packaged food space, but management has been able to drive higher profitability with a cost-cutting program. The combination there is lethal, so I want to repeat it. A game-changing acquisition that increases sales and an operating efficiency program that cuts costs. You see, usually when a company makes that big acquisition, buying another big company to increase its sales, costs balloon and profitability falls. So sales might increase, but earnings don't increase by as much because of those lower profitability margins. But what we had here was higher sales plus higher profit margins. So a big win for General Mills, and something you always want to watch for: responsible acquisitions that increase sales but not at the expense of profits. Now Banco ZK is another stock that gave us almost all our gains in that first quarter, and I actually cut it back from 10% of the portfolio to 5% in February. Now deposit gathering banks have had a tough go lately on those lower long-term rates, but what most investors don't know about OZK is that it has a huge real estate loan business as well. It has that traditional community bank feel, but the booming market for real estate loans has really been the push for this one. When we added this one, it was trading at a price to book value of just 0.76, but has come up to 0.99 times book value right now. I still think there's some long-term growth, especially as the bank expands into the Nashville market, but that deep value has come out of the shares. Conagra Barnes is one we added in February, just before the huge pop in the shares, and a 34% return for the year. This is another example of an acquisition driving sales and management forcing profitability. In Conagra's case, it wasn't getting much credit for that 2018 Pinnacle acquisition. The deal had just closed in October, and investors were selling the shares in November and December over disappointing results. Now, a lot of the problem was centered around Pinnacle's distribution business, so I saw that it wasn't necessarily a problem that management couldn't fix. They went extremely conservative on the profit outlook and ended up surprising on the upside in March. You have got to play the contrarian sometimes with finding the clues that the rest of the market is missing. Investor sentiment is herd mentality, and a lot of times it's going to push a stock lower when the reasons for upside are staring you right in the face. China life insurance is another one that took a huge hit on that trade war, but it's still up 32% for the year. Now, I will admit my pick on China life wasn't for a short-term gain, which doesn't make much sense for a one-year stock market challenge, but I wanted to put this one on your radar. Like we pointed out in January, China's economy is growing at 6+% a year, 3 times the growth here in the United States. The trade war has hurt, but China's government has a lot of ammunition to juice that economy. Honestly, folks, you need exposure to Chinese stocks if you're going to be investing over the next decades to come. Within that theme, China Life controls a fifth of the life insurance market. That's 1.4 billion people in a country where life insurance penetration is still relatively low. Now, the dividend has been volatile on this one, and last month's payment was lower to protect cash flow, but I am expecting the shares to strengthen on this one, and they may make a special dividend if the economic growth rebounds after the trade war. I'm linking here to a new dividend portfolio I just created. If you want your dividend stocks to pay your bills, click on the video to the right. 7 dividend stocks that are going to put cash in your pocket every single month. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.